Hello and welcome. We're watching All About Your Company here on ET Now. I'm Harsh Saita. Today we're going to be talking about J&K Bank. Now, why J&K Bank? It trades at sub one-time book and well below one-time book, in fact, and it's clocking an ROA of 1.3%, at least this quarter. It's done 8% sequential growth, but on the back of 2 quarters which have been softer in terms of the growth glide path. Therefore, we'll try to understand what the growth roadmap looks like over the next couple of years, what the levers look like. Also, it's at an interesting inflection point. They're doing a lot of lending outside of J&K and Ladakh, which is their predominant territory of operations, and the advances mix as a part of the overall loan book has gone up versus when you're looking at earlier outside of that territory, which is J&K and Ladakh, and therefore we'll try and understand as to how that's playing out. But first off, what are the drivers for that 8% sequential growth that they've clocked, and how sustainable is this kind of a growth number? Now, for a bank trading at sub 0.7 time book 1 year forward, that also basis profit computed last year, it's quite interesting to see as to how this will play out. So that's point number one. The second piece is with regard to margins. Now, they've guided for margins of 3.65 to 3.7%, but what could a possible 25 basis point further repo rate cut mean if that were to come in February? What would that mean for margins? Because margins have come under pressure in the recent quarters, which is in Q2. Q3, we've seen a bit of a recovery despite the 25 bips cut. My hope is that they will still hold on to that 3.65 to 3.7% margin guidance. The third piece is with regard to cost of deposits. Now, it's super low. So I'm trying to understand, one, can it continue to remain so because they garner a lot of their deposits from J&K and Ladakh, and therefore that's a favorable mix that they have and a favorable market that they have to attract deposits. And second, how quickly do they shrink? Because we are in that kind of a cycle where at least the deposit repricing is at play. I'm trying to understand whether margins in FY27 can surprise on the upside, and what would that number be that we can start to pencil in. The fourth piece is with regard to credit cost. What they've guided for a sub 1% normalized credit cost. They've not done any credit cost because of recoveries that are coming through, and the recovery pipeline continues to remain strong. More importantly, I want to know the timing of it. When will that happen? The fifth piece is the capital adequacy post the fundraise. How much of comfort does it give in terms of the lending, or rather the growth roadmap over the next 2 to 3 years? Because that is an important component. They are at 15% capital adequacy. They've done a fundraise as well. I'm trying to get to as to whether we can expect stronger growth going forward. And I want to know the business mix. We spoke about this, rest of India versus J&K and Ladakh, what the business mix is and where the profitability will largely come from, what the focus area and what the strategy of the bank is with regard to both those areas. Now, let's talk about the company. It's one of the oldest private sector banks, treated as a private sector bank only because it's owned by the government of J&K and the government of Ladakh. But it was incorporated in 1938. It's headquartered in Srinagar. It serves retail, corporate, agriculture, MSME customers largely. It's majority owned by J&K and Ladakh governments. We spoke about that. And it has a 1,017 branch strong network. And predominantly that network operates out of J&K and Ladakh. Who do they lend to? Retail is 65% of the loan mix. Corporate is 35%. This was 68-32 exactly a year back. This has changed. So corporate has started to pick up both in terms of growth as well as in terms of the larger mix of customers. I'd also want to understand whether this number changes. And if it does, where do margins go? Because your yields will largely be determined as to whether there's a higher retail mix. Typically, your yields go up. If corporate goes up, then your yields come down. So that's something I'd want to know as well. Let's talk about branch distribution. They have 1,017 branches. We spoke about this. 54% of those branches are rural. 18% are in metros. Semi-urban is 17 and urban is 11. So that's broadly the breakup. But predominantly 50+% is rural, understandably so. And when I give you the geographic split, you'll get a better perspective. J&K and Ladakh is 878 out of the 1017 branches. So nearly 85% plus of the branches are sitting out of J&K and Ladakh. Rest of India is just 15%. ATMs, they have around 1500 ATMs that they operate. Now let's talk about the loan book. You've got a good sense, 85% branches, 85% plus in J&K Ladakh, just about 15% in rest of India. But look at where the loan book is coming from. 33% of the loan book is coming from rest of India versus 67% from Ladakh. So they're doing increased lending from the rest of India, probably even through corporate. We'll try and get a pulse of that. But look at the deposit garnering. All of that is happening from J&K and Ladakh. 86% of the deposit book is coming from J&K and Ladakh, just 14% from rest of India. Does this queue get better? Likely so. Does rest of India come more into the picture? Likely so. But does that mean J&K and Ladakh is maxed out, or how does it play out? Also, the CASA ratio has fallen. We'll try and talk about that when we talk about the metrics. And in fact, let's go straight to the metrics. Let's look at the P&L account and what the bank has done over the last 3 years. You've seen NII growth very steady, 14%. You'd see the kind of linear growth that they've done. Fairly good, right? Fairly stable in terms of the growth number, and 14% CAGR is not bad at all. Stability there, but look at the operating profit. That's gone up by 40%. Some amount of OPEX tweaking has happened, so that's aiding the numbers. You've also got the tailwind of other income coming, which is aiding the numbers. So both of those has aided the profit, the operating profit number, which is up 40% CAGR over the last 3 years. This is, of course, 3 years CAGR ended FY25. We will talk to you also about the metrics of Q1 and Q2 and Q3 FY26. But for the moment, this is what it is. You look at the provisioning, absolutely flat. There's no concern with regard to the provisioning at all. The last 3 years, the provisioning has been either sub 100 crore or negative. So credit cost being negative is because recoveries have exceeded the provisioning that they've done. But they've guided for a credit cost number of sub 1% on a normalized level. We spoke about this, viewers, and therefore that's something we'll understand better. Net profit CAGR 61% as a result. It's just shot up of a very low base of FY22. FY22, the provisioning number was at around 300 crore, and therefore it's been a very, very sharp shoot up because it's been aided by a lower credit cost number and very quick operating profit growth. Let's talk about the balance sheet now. The loan book has grown at 12% CAGR over the last 3 years. Deposit book growth of 9% CAGR. And you look at the CASA ratio, that's one of the questions that I have for the management. The CASA ratio has come off when you're looking at it on a percentage basis. 57 to 54 to 51 to 47 to 44 currently. And that could be one of the possible concerns, because cost of deposits then start to inch upwards when CASA comes down. CASA is lower cost deposit. Deposits are raw materials for banks. Let me now talk about capital adequacy. And when you're looking at capital adequacy, it's currently sitting at 15%. They've done a fundraise as well, a QIP. And for the moment, it's 15%. I wonder if they've added back the profitability. They've added back QIP. We'll try and quiz them on that. But broadly, that's the number we're currently working with. Let's look at operational metrics as well. In terms of yields, the yields have largely been between 8.3 and 9.5. They've come off because the yield environment has changed. The repo rate cuts have been given effect too. Let's look at the net interest margins. They've largely been between 3.92 and 3.62, so very tight margin band. And that is because, or 3.56, very tight margin band. And that is largely because of the fact that you've got access to low-cost deposits. And therefore, when you're looking at cost of funds, you'll get a perspective. It's between 3.8 and 4.9. Very, very low in terms of the cost of funds that they operate with. So that's a big, big positive when you're looking at something like J&K Bank. Let's look at credit costs now. Before that, let's look at cost to income. The cost to income ratio has hovered between 62 and 56, and therefore currently we're at the lower end of the band, which is why you're getting tailwind of operating profit growth as well. So that's the other positive which is playing out. I wonder if it starts to inch up in any way, even though the branch network growth that they've estimated is not too sharp. They've estimated maybe 2 to 3% annual branch network growth. Look at credit cost now. Absolutely zero at this point. In fact, has been zero for a while now. it was around 30 to 40 bips in FY22, but outside of that, it's been virtually zero. You look at the ROA trends, therefore, from 0.4 in FY22, ROA has seen a sharp lift, 1.35% in the current quarter is what we've seen the ROA at. Look at asset quality. Asset quality trends have trended in a very downward sloping channel. You're looking at gross stage 3 or the GNPA trend from 8.67% in FY22, it's down to 3% now. The NNPA trend from 2.5% is now down to sub 0.7%. So you're seeing better asset quality metrics starting to play out, favorable tailwind with regard to asset quality. You look at return ratios as well, and you've seen a gradual spike up from 8% in FY22. It's spiked up to 18% in FY24, and thereafter it's remained in that channel between 14 and 18%, which is very healthy for a PSU bank, sub one-time price to book. So that's the other piece we want to highlight. Quickly on to shareholding. You look at the promoter holding, it's at 59% currently. FIs hold 8%, DIs hold 6%, and public holds around 26. But you look at the inch up with regard to the FI number. If you just look at that, you look at those numbers, it was 2% in FY23. FIs now hold 8%. DIs held 3%, currently holds 6%. And the public shareholding has gone down from 32 to 26. That's something that looks very interesting because you've started to see participation of institutional investors in this. Now let's look at valuations, analyze this a little better. Current price to book is 132 at the end of Q3. You have a market price of around 102, which gives it a price to book of 0.7 or 0.8 times current. This is the current price to book. But your EPS has been 19 rupees. Now, I know that there's a fresh equity issue which has happened. I'm assuming that EPS to remain so, right, at 19 rupees a share. The 1 year forward will be at around 150 rupees a share. And therefore, you're looking at a 1 year forward calculated price to book based on the assumption of a 19 rupee EPS post the fundraise to be at 0.7 times. This is, of course, if that math adds up to be right. So those assumptions need to be kept in mind, which I have made. We'll try and, there you go, that's a snapshot of the entire analysis that we've done. What we'll do is we'll slip into a very short break. On the other side, we'll speak with the management. We will be joined by Mr. Amitava Chatterjee, Managing Director and CEO at J&K Bank, now driving the growth of J&K Bank. Stay with us here on ET Now. Welcome back. We've analyzed J&K Bank, and let's go across. We have Mr. Amitava Chatterjee, Managing Director and CEO at J&K Bank, joining us this afternoon. Mr. Chatterjee, great having you. I want to first off start with that very impressive growth number that you've clocked, 8% QOQ. I'm trying to understand sustainability of that. Where is it coming from? And whether you can beat your 12% loan growth guidance for FY26.
Thank you very much. First of all, I would like to compliment on the kind of analysis and the numbers that you displayed about the bank.
Thank you, sir.
It was refreshing for me as well. Yes, definitely. If I talk about the loan growth, the start of the year guidance was around 12%. At that point of time, we were undergoing certain transformations like end-to-end digital loan processes and all. So once that got stabilized, in the second quarter and in the third quarter, we had a very good loan growth, which has exceeded the market guidance. At the moment, I think YOY growth has been 17% plus. I would still hold on to my guidance of 12 to 15%, which I spoke of at the end of the second quarter. We are very confident of having 12 to 15% credit growth. The overall growth that has come, profitability, etc., that has come in an overall, all the factors that contributes to profitability have contributed to the bank's profit this year. I can tell you that. Because of the expanded credit growth, the average advances, they have gone up, so interest income has gone up. The other income, as you mentioned, has substantially improved. So that has helped in, again, the profitability. So all the factors that contribute towards a healthy growth for a bank. For example, you spoke about the NPAs. Now, we have been able to not only contain the NPAs, we have been able to contain slippages as well. We have been able to, even in not only in percentage terms, we have been able to reduce NPAs in absolute terms as well, YOY. So the focus of the bank on all these fundamental parameters have been very, very strong. And I won't say that it is only for the last 4 quarters, it has been for the last 9, 10 quarters. So this has been going on. And the result today you see is because of that.
Right. So you've done more of corporate. Which means it's slightly lower yielding. Would that be the right inference to make? And your rest of India portfolio, does the corporate portfolio lie in ROI? And is that why the ROI portfolio is, as a component of the total portfolio, is larger? How should one see that evolving going forward?
Our, as you mentioned, the total corporate loan book is around 35%. We will try to maintain it at 35% because essentially the bank is a retail oriented bank. And obviously, as you said, the margins come from the retail loan book. So we will continue the focus on the retail. What we have added, yes, I'll directly answer one question. Most of the corporate loan growth has happened in rest of India. That has been the history for this bank. But what we have done now is penetrate rest of India with our retail products as well. Car loans and home loans, they both have, in fact, car loan has given a double-digit growth in rest of India. Home loan has given a growth of almost 30% in rest of India. So we have also penetrated into the retail products in rest of India. The essential strategy has been to leverage the presence of this bank in 22 states. Uh, Earlier, I think most of the banking was happening in the home territory. Now we have started expanding while continuing our focus in the home territory. Because again, if you look at the composition of deposits, most of the deposits come from the home territory. So we need to continue our focus. The retail loan book essentially has been in the home territory. So these focuses will remain. However, we are trying to leverage the rest of India presence that we have.
Right. So just to try and get a sense, so rest of India within retail, how much of your retail book is rest of India, and how quick is the retail rest of India growing versus retail home territory?
See, if you look at, see, the base is very small. The retail
Okay.
base of rest of India is very small. Till very short while back, there was hardly any retail loan book in rest of India. We have started penetrating into that that area in the last, say, 5 to 6 quarters. So the growth, if you look at the growth on the base, the retail loan book is growing at around 10% in the home territory, while in rest of India, the retail loan book is growing at around 20%, 25%. The idea is to have a 50% share going forward, not in the overall portfolio, but in the additional growth that happens. 50% share should come from rest of India. That is the idea. And we are trying to reach there in the next couple of years' time.
Perfect. Okay. So talk to us about margins, therefore. Say we have another 25 bips rate cut possible in February. Does that pressure margins for you? And thereafter, how quickly do margins go up? What's the margin trajectory looking like? You're looking at 3.65 to 3.7 as the FY26 guidance. What should we expect in FY27?
See, I'll give you both the scenarios. In case there is no rate cut, I expect the margins to be around 3.7, slightly maybe above that. If there is another rate cut, I believe the margins we will be able to hold on to the margins we have now, 3.62 to 3.64. The main reason is the transmission of the rate cut to the loan book has already been transmitted. The deposit transmission, the normalization has happened almost with a lag of 1 to 1.5 quarters. So that has resulted in an improvement in the margin from quarter 2 to quarter 3 by 6 basis points. I expect it to go up by another 6 basis points in the next quarter if there is no other further rate cut. If there is another rate cut, I believe we will be able to maintain the margins that we are having now. And
Understood.
for 27, you asked, for 27, the same thing applies. We are like you mentioned, the margins are largely dependent on our CASA book. And CASA, even though it has come down in percentage terms, we have been able to add on in absolute terms, and we have undertaken a huge campaign within Jammu and Kashmir to improve our CASA, which I believe we'll be able to improve in percentage terms also going forward. So the margins are unlikely to go down anymore.
Thank you, sir. You've answered two of my questions. Now to the key question. Right now, everything that's aiding your ROA is the credit cost number. When do they normalize? Your credit cost guidance is when it normalizes, it will be sub 1%. When does that happen? Which year?
If I answer that question directly, post quarter 2 FY 26-27.
Okay. Post quarter 2 FY27. Understood. Is the credit cost going to be higher because you're doing ROI and rest of India, and you haven't tested that book enough? Is that a concern?
Not at all. Not at all. The rest of India book is very, very safe. If you look at the corporate book, if you happen to go deep dive into it, they are all AAA rated entities. So I do not envisage any stress in those accounts, first of all. Second, see, the initial guidance of a credit cost sub 1 was given based on the fact that what had happened in this geography post 22nd April. But then we were able to contain, number one, with the resilience of the citizen of this geography, first of all. Second, we were able to implement the master circular related to rehabilitation by Reserve Bank of India, where we rehabilitated almost 10,600 accounts, amounting to 14,600 crores. So this 1,400 crores, sorry. So this has helped us in steadying the stress or the portfolio, and all these accounts are standard accounts, and going forward I do not see any reason why they will be slipping, while initially the threat was there. So we have been able to surpass that threat.
Okay. With regard to your capital adequacy, post this fundraise that you've done, where does your capital adequacy therefore sit at now? Does it give you a couple of quarters of solid growth or a couple of years of solid growth therefore? And what does it do to your ROA and your ROE, if you can give us a perspective?
Just a correction. We have not yet undertaken the fundraising. It is on the offing. We have just got a approval from the board. Our CRAR at the moment is 15%, as you are showing on the screen. This is without the profit. So we add the profit, it adds 145 bips to that. So we are comfortably placed. End of the year, if we are able to achieve, say, 15-16% credit growth, and taking everything into account, we will be somewhere around 16%, even if we do not do the fundraising. So fundraising at the moment is not something which is very, very urgent for us. But yes, what we are looking at is a very comfortable capital position, so that when we look at, and since we have started this journey of a robust growth, especially in the credit side for the bank, we feel that going forward, I think in the second quarter of next financial year, we will be completing the QIP. And we will rest on a capital of around 17 to 17.5%.
Mr. Chatterjee, it's been a complete pleasure. I'm slightly short on time. I would have squeezed in a question or two, but thank you so much for coming in and speaking with us. This has been good. Viewers,
Thank
that's
you very
all.
much. Thank you.
Right, viewers, that's all, in fact, that we have on this edition of AYC. From all of us who put the show together, thanks so much for watching. Stay with us here on ET Now. More action on the other side.